Ladies and gentlemen, Archivist here. Stop looking at the Dow Jones Industrial Average. It is a hallucination. It is a theater of liquidity designed to keep you sedated while the foundation of the global ledger rots beneath your feet. If you are looking at the stock market, you are looking at the past. I am looking at the crime scene. And the crime scene is not on Wall Street. It is in the futures market for silver. Specifically, it is in the Commitments of Traders report, a boring spreadsheet that just screamed a warning signal loud enough to shatter glass. The financial media is talking about a trade war with Europe. They are talking about President Trump and Greenland. They are distracted by the noise. They are missing the signal. The signal is this: the smartest guys in the room, the hedge funds, the algorithm writers, the masters of the universe have just made the biggest mistake of their careers. They have bet the house that silver prices will fall precisely at the moment the physical supply line has been severed. This is not a trading opportunity. This is a trap. It is a bear trap the size of the Atlantic Ocean, and the jaws are about to snap shut. Let us look at the forensic data that the CNBC anchors are too polite to mention. According to the latest data from Bloomberg, the net long position of hedge funds in the silver market has dropped to its lowest level in 22 months. Think about what that means. It means the speculators are betting on deflation. They are betting on a strong dollar. They are betting that the status quo will hold. They have positioned themselves for a world where peace breaks out and supply chains heal. They are betting against reality. Because while they were punching sell orders into their terminals, the physical world shifted on its axis. Let me walk you through the anatomy of this disaster. When the President of the United States just declared economic war on his oldest allies in Europe, the 10% tariff on Denmark, and the United Kingdom is not a negotiation tactic. It is a kinetic event. It creates immediate friction in the movement of goods. 2, the mine at El Teniente in Chile, the beating heart of the global copper and silver supply, has suffered a catastrophic structural failure. 5 men are dead. That is a tragedy for their families. For the market, it is a signal of zero supply. The Andesita project is frozen. This means the concentrate required to feed the smelters in China is not coming. 3, the Shanghai Gold Exchange is now trading silver at a premium of more than $8 over London. Do you understand what that number implies? It is not an arbitrage window. It is a vacuum cleaner. The Chinese industrial complex is sucking every available ounce of physical metal out of the West, leaving nothing but paper promises behind. So here is the setup. On one side, you have the paper market in New York, dominated by hedge funds who are short-selling paper contracts because their algorithms tell them to fight inflation. On the other side, you have a physical shortage is absolute. The warehouses are empty, the mines are broken, and the trade routes are blocked. When these two forces collide, it will not be a correction. It will be a liquidation event. The hedge funds will be forced to cover their short positions, but who will sell to them? The miners cannot sell because the rocks are stuck in the ground. The Chinese will not sell because they need the metal for their solar panels and missiles. So the price has to go vertical. This is the definition of a short squeeze. It is a panic buy in a burning theater where the exit doors are welded shut. You must understand the psychology of the institutional investor. They do not care about value, they care about liquidity. When the margin clerk calls, they do not ask questions. They sell what they can to buy what they must. And right now they must buy silver to close out their losing bets. But there is no silver to buy. This creates a feedback loop of destruction. The higher the price goes, the more they have to buy. The more they buy, the higher the price goes. It is a mathematical inevitability. It is the same mechanic that broke the nickel market in London in 2022. But silver is not nickel. Silver is money. Silver is the essential component in the Tomahawk missiles and the Golden Dome defense system that the United States government is rushing to build. Do not listen to the economists who say that demand is softening. Demand is not softening. It is shifting from consumer electronics to kinetic warfare. The United States military does not care about the price of silver. They will pay any price to secure the guidance systems for their weapons. And they will print the dollars to do it. This is the ultimate inflationary pressure. And the hedge funds are standing in front of this freight train holding a handful of paper contracts promising to sell metal they do not own. It is financial suicide. Let us go deeper into the forensic evidence. Look at the vaults. The data from the COMEX in New York shows that registered silver, the category of metal that is actually available for delivery, has plummeted to levels that threaten the integrity of the exchange. We are seeing the market flip into backwardation. This is a technical term that you need to tattoo on your brain. Backwardation means that the cash price for silver today is higher than the futures price for silver next month. In a normal healthy market, future prices are higher because you have to pay for storage and insurance. When the spot price is higher, it means one thing: panic. It means the industry creates desperate, immediate demand. They need the metal now. They cannot wait 4 weeks. This is the market screaming that there is no inventory. And yet the price on the screen is still being suppressed by these paper bets. This divergence cannot last. It is a coiled spring. The tension is building with every ounce that leaves the vault in London and heads to a factory in Shanghai or a defense plant in Arizona. When the spring snaps, it will take the solvency of these funds with it. And if you are holding paper silver, like the SLV exchange traded fund, you are standing in the blast radius, because when the funds collapse, the paper claims they issued will be worth exactly the value of the paper they are printed on zero. Why is this happening now? Why is the timing so critical? Because of the Arctic ultimatum, the decision by the United States to weaponize tariffs against NATO allies over the Greenland issue changes the calculation for risk premiums everywhere. Lloyd's of London is already recalculating more risk. Insurance for the North Atlantic. This adds cost to every shipment. It adds friction. Friction is inflation, and inflation is the kryptonite of the bond market. When the bond market realizes that inflation, structural, not transitory yields, will spike, the Fed will be forced to intervene. They will have to print money to buy the bonds to keep the government solvent. And when they print money, the dollar dies a little faster. And when the dollar dies, silver flies. This is the cycle. The hedge funds are looking at the Fed, believing that Jerome Powell will keep rates high to fight inflation. They do not see that Powell is a dead man walking. They do not see that the Department of Justice investigation into the Fed headquarters renovation is a political assassination attempt. Powell will be removed or neutralized. Rates will be cut to fund the war machine. The dollar will be debased, and the short position held by these funds will be incinerated. Let me be clear about the villains in the story. The villain is not the miner digging the rock. The villain is the financial engineer who sells a claim on rock that does not exist. They have suppressed the price of silver for decades, allowing the West to enjoy cheap electronics and cheap energy. But the bull has come due. The subsidy is over. The Chinese know this. That is why they are draining the London vaults. They are taking the physical collateral, leaving the West with the empty bag, and the bag holders will be the pension funds and the retail investors who trusted the paper price. You are watching a game of musical chairs played on a global scale. The music has stopped. The Chinese sat down, the Russians sat down, the central bank sat down, the hedge funds are still dancing, and they are about to realize there are no chairs left. This is the setup for a wealth transfer of historic proportions. Wealth is moving from those who hold paper to those who hold things, from the financial economy to the physical economy, from the algorithm to the atom. So what is the implication for you? The implication is that the price you see on your screen is a lie. It is a legacy number. It is a ghost. It reflects a world that existed before the El Teniente collapse, before the Greenland ultimatum, and before the Shanghai spread blew out to $8. Do not wait for the price to confirm the thesis. By the time the price reflects reality, it will be too late. The gap will be filled in minutes, not days. You will wake up and the market will be locked, limit up. You will be on the outside looking in. This is a war of attrition. The mines are old, the grades are falling. It takes 3 times as much earth removal to get the same amount of copper and silver as it did 20 years ago. This is geology fighting against finance, and geology always wins. Energy costs are rising, labor costs are rising. Political instability in Peru and Mexico is rising, and yet the paper price says silver is cheap. This is the cognitive dissonance that creates the opportunity of a lifetime, but it is only an opportunity if you are on the right side of the trade. If you are short, you are dead. If you are unallocated, you are dead. If you are holding physical, you are the bank. Now, let us talk about the specific victims of the squeeze. It will not just be the hedge funds. The industrial users are the ones who will suffer. The German solar manufacturers, who are already on the brink of bankruptcy, will face a supply shock that wipes out their margins completely. Tesla and the electric vehicle supply chain will face delays. Companies like Apple and Samsung will see their cost of goods sold explode. These are the zombie companies of the new era. They rely on just-in-time delivery of cheap materials. That era is over. We are entering the era of just-in-case, and whatever the cost. The short squeeze of 2026 will be written about in textbooks. It will be the moment the fiat currency system lost control of the commodity complex. It is the moment the tail stopped wagging the dog. The paper market is the tail, the physical market is the dog, and the dog is waking up and it is hungry. So what is the protocol? How do you position yourself in front of this kinetic event? You must exercise the resource denial protocol. You must deny the system your capital, and you must deny them the ability to settle in paper. Rule number 1, liquidate all paper silver positions. If you hold SLV, sell it. If you hold unallocated pool accounts at a bank, close them. These are unsecured loans to a bankrupt counterparty. You do not own metal, you own a credit risk. When the squeeze happens, these institutions will force settle your contracts in cash. You will get dollars that are rapidly losing value while the metal goes to the moon. Do not let them buy you out with confetti. Rule number 2, buy the miners who control the ground. Look at Pan American Silver ticker, PAAS. They have the reserves, they have the jurisdiction mix. Look at Hecla Mining, ticker HL. These are North American assets. They are strategic. The United States government will protect these assets because they need the metal for the Golden Dome. Do not buy junior explorers in unstable dictatorships. Buy the established producers in North America. Buy the ground. Rule number 3, physical possession. If you can find it, buy sovereign minted coins. American Silver Eagles, Canadian Maples government-issued bullion carries a legal weight that generic rounds do not. It is harder for them to confiscate. It is easier to travel with. Remember, I am not telling you melt down pre-1982 pennies. That is illegal. I am telling you that copper pennies and nickel nickels are the only circulating currency that has intrinsic value. Keep them as a survival option, but for wealth preservation, you need silver ounces in your hand. Rule number 4, short the users. Sell the companies that depend on cheap silver, sell the tech hardware stocks, sell the solar installers who do not have locked-in supply contracts. They are walking into a buzzsaw of inflation. Their margins are about to evaporate. Their earnings guidance is a lie because they are calculating costs based on yesterday's silver price, not tomorrow's. This is not investment advice. This is a survival briefing. The system is breaking. The spread between London and Shanghai is the crack in the dam. The water is coming. The hedge funds are trapped in the valley below. You have a chance to climb to higher ground. Do not waste it. Now for the audit. Go to your safe, go to your pantry. I want you to count your ounces. Do not tell me the dollar value. I do not care about the dollar value. The dollar is a measuring tape that is shrinking every day. Tell me the weight. How many ounces of silver do you physically control? If the internet goes down, if the exchange closes, do you still own it? If the answer is 0, you are a casualty. You are a bag holder for the hedge funds. I also want you to audit your energy resilience. The grid is fragile. The supply chain for spare parts is broken when the brownouts start because the copper is not arriving to fix the transformers. What is your backup? What is the specific kilowatt rating of your generator? Do you have enough fuel stored to run it for 2 weeks? Do not guess. Go and check. Check the expiration date on your antibiotics. Check the caliber of your ammunition to match your hardware. The world is moving from a high-trust paper system to a zero-trust physical system. The short squeeze in silver is just the opening salvo in a much larger war. It is a war for resources. It is a war for survival. The hedge funds are on the wrong side of history. Do not join them. The insurance adjusters have left the building. The protocol is active.